My name is Amin Musa. I'm a partner at ALN. I head our projects and infrastructure practice. The topic for discussion today is strengthening transport and logistics infrastructure to power Kenya's supply chain competitiveness. And I think this is clearly a topic, a hot topic of great interest. In the post-COVID world, when you think about two of the big disruptions, it's diversification of supply chain and AI and technology linked to that, critical minerals. And so the question is, what is the role of Africa and specifically Kenya in this age of disruption? The opportunities are significant if the continent and Kenya as a country can get its act together on a number of key issues. And the purpose of this discussion specifically is to discuss what needs to be done on the transport and logistics space given these changes in relation to supply chain diversification and all the activity that we see around critical minerals and the mining of that. We are currently involved in transactions across East and Central Africa that are directly linked to this conversation, from setting up special economic zones within the region. We're doing port and terminal deals in places like Tanzania, Djibouti, Zambia, Namibia, etc., where this is the key driver for how do you get goods manufactured in East and Central Africa because of supply chain diversification. But more importantly, how do we get our critical minerals out for export? And if you look at our costings within East and Central Africa and within Kenya, we are multiple times more expensive than international market requirements. Now, whilst Kenya has done a pretty good job of developing infrastructure over the last decade, and we get a pretty decent World Bank scoring, there's a lot that needs to be done. And when you think about what our neighboring countries are doing, like Tanzania and Ethiopia, like I said, I've just done 3 port concessions in Tanzania. They've got over this issue about the private sector running their ports and their rail because they see the opportunity coming from DRC. And so the question is, what are we going to do as Kenya to stay relevant and be part of this opportunity? And then what will we do regionally? So I'm very pleased to have an excellent panel here to have that discussion. I'll actually ask each of them to do a brief introduction. It's probably better than me reading out their bios. So, Phil, why don't we start with yourself?
Pleasure to be here. Pleasure to be in company of friends. Can I say that? Friends up here and friends in the audience. My name's Philip Dyke. I'm the managing partner of Everstrong Capital. My background is more than 35 years involved in privately financing infrastructure internationally, focused exclusively on investing in infrastructure in Africa for the last 10 years. I live in Nairobi, Kenya. Ultimately, I'm an American living in Kenya.
Thank you very much for participating in this afternoon session. I work for Trademark Africa. It's an 8-foot trade institution. So we invest on projects with the government. Today we work in 23 countries, but a lot of our initial work was in East Africa, where we have invested over $500 million on different infrastructure projects. We have built 16 border posts in the region. We have done a lot of work at the port of Mombasa. We have built logistics facilities, lake ports, and multiple connecting roads, and I head our infrastructure work in Trademark.
My name is Christine Nganga. I'm a director at the PPP Directorate. So PPP projects in government come through my desk. I'd like to acknowledge my boss sitting right here, Engineer Kefa Seda. He's the Director General of the PPP Directorate. And as the Directorate, we are really, I would say, function as a trusted advisor to contracting authorities within government to help them execute their PPP projects. And some of our projects, many of you may have used some, others you do not know. Of course, most of you must have used the Expressway, which is one of our projects. I'm sure you're aware of the Nairobi-Nakuru Summit that we're working on. And we have other road projects, at least another 5 or so. We're in energy, we're in transmission, we're in housing for defense forces. So there's a lot we're doing at the PPP Directorate. Thank you.
Let's start the conversation. Philip, if we can start with you, going back to my discussion about what's happening on supply chain diversification, mining, et cetera, and then we think about our corridor. And a lot of people tell me that the corridor from Mombasa onwards is probably one of the most important corridors on the continent. How do you rate where Kenya stands today in terms of the infrastructure we have given these disruptions and opportunities that we're seeing globally and especially on the continent in Africa?
Let me answer that by saying I've certainly observed in the roughly 10 years that I've been focusing on Kenya and East Africa, a lot of progress. SGR came into reality. The Nairobi Expressway came into reality. And these are good signs of what is happening in developing infrastructure here in Kenya and in East Africa. And then I look around and you know, we're talking about minerals and how do we get minerals to the market. And if the minerals are on the coast, it's one thing. But if the minerals are in DRC or Uganda, it's a much different thing. And then I have to come and say that the infrastructure between Nairobi and Mombasa has a lot of room for improvement. SGR exists, it's taking a certain amount of traffic, but the reality is you've got a 2-lane road servicing the most important port in East Africa. Last year, the growth in imported containers in the port of Mombasa increased by 11%. The road didn't improve in efficiency. I'm sure that there were some improvements on SGR, but in our studies, we use experts, and I mean, despite what you're saying, that Kenya gets a good rating, our assessment of the road is one where the experts are saying because the road is so congested and so slow, it almost has a failing grade. The only thing that would be worse is the road was not even there. And so that's one of the things that we're trying to work on improving. It's a great opportunity. We are leading an effort to put together a consortia together with Kenya Highways Authority and the PPP unit, putting it together to address the questions and the requests that have come to us over time. We've learned to listen. Maybe we started out by not listening as much as we should, but now we're listening. And we're confident that we'll deliver a road that will improve the commute for these logistics trucks and companies, not only to Nairobi, but then taking the work that's ongoing to Mau Summit, ultimately to the border of Uganda. All of these things fit together. I believe there's a great future, and we're happy to be part of it by leading the PPP for the Nairobi-Mombasa Expressway.
Abhishek, I guess we've got, shall we call a Kenyan scorecard. If we now look at regionally, because ultimately this is all about regional integration and moving goods in and out within the region. And when you look at what's happening between, for example, Tanzania and Zambia on the Tazara rail, you're looking at the Tanzania port privatization. You're looking at what Ethiopia is doing in the aviation sector with regards to the new airport, the airline, etc. Again, how do you then rate that, and how do you then link that to where Kenya stands, and what do those initiatives mean for our competitiveness and our connectivity as Kenya?
One, Kenya has a great opportunity as an exporter of critical minerals because a lot of the important critical minerals are in the Great Lakes region. There are many challenges to the Great Lakes region, but there are significant volumes of critical minerals that are already moving, and they have only a few choices between the two ports, either Dar es Salaam or Nairobi. Now, they're very different to other goods because they have one extremely high value. So while a container of rice is 50,000, I mean, anywhere from $30,000 to $50,000, a container of minerals is $1 million. So the transportation requirements are quite different in terms of high security movement that is required in addition to speed of movement. And so the movement requires, depending on the mineral type, both rail and air movement. So, it depends on the type of mineral that we are talking about. Now, the one thing that has happened, we discovered these critical minerals during COVID. Before that, there was still a concentration of all these minerals processing happening in China. No one really thought so much about it. But since COVID, and when we first had the crisis, when we discovered that most of the masks and the PPE equipment were being manufactured only in China, and we just did not have any control over it, this conversation started. And what the CRM has done is it has also started a strong conversation on rail, because we have been talking rail in this region forever, but we have never really moved on rail to a significant extent, apart from the SGR line that we built to Nairobi. What we are discovering, especially in the Copper Belt and moving to Tanzania as well as to South Africa, is that even the rails there are defunct, and the roads are being absolutely destroyed by these mineral movements. And so not only is the road now not good enough for a lot of the mineral movements, so the costs are increasing dramatically, but they're also not good for a lot of the other movements that are happening. So if you look at the roads in Mozambique, in Zimbabwe, going towards South Africa, some of the key ports, you find, for example, Durban has become one of the worst performing ports there because there's such a massive congestion of trucks. In Kenya, we have an opportunity. We have rehabilitated the meter gauge railway. We are looking at the connection to Uganda railways. In Uganda, there is a capacity issue as well around it, which we need to work together as countries. Even for Kenya, we had a strong capacity issue with Kenya Railways at the time SGR came in, but a lot of capacity has been built over the years, and there is need to support our neighboring countries on the rail side of it. And then aviation also needs to become an important part of this mineral logistics, because some of these minerals, as I said, just need to fly. And so having secure transportation is essential. In that sense, I think we need a specific CRM policy. So while we have the mining laws which have been reformed and they are very specific on how investments can come in, we need to also have a transportation policy specific to the critical minerals and the rare earth minerals that we are talking about, because the challenges are completely different from the movement of rice and oil and wood and other commodities. So I think for Kenya, we are not in the center of the mining economy as so much as Tanzania is, because we are at a distance from the copper belt, so we don't have the bulk movements moving through. But we have high-value minerals in our neighborhood, which we need to target. We haven't done so as much, both as a processing hub of those, and second, as a transportation hub, providing the appropriate secure solutions to the rest of the world.
Christine, being at the heart of the PPP unit, you clearly have an incredible lens to understand what government policy is and what the vision is. We've just heard from Phil and Abhishek telling us about the significant opportunities that exist given these disruptions, but also the challenges. And we've also heard about what our neighbors are doing to frankly get into this game. What are the government priorities, taking into account requirements to grow manufacturing and be part of the critical mining play? From a transport and logistics perspective, what are the government priorities in the short to medium term for the transport and logistics sector so that we are part of this connectivity?
So I'll discuss it with a slant towards PPP. There's what the Ministry of Transport is looking at, but there's what fits within the PPP framework, which is where we are seated. So in terms of the transport sector, we're keen on all aspects of transport, from road to rail to ports to airports. And that is a clear focus of the government, also because of the Africa Continental Free Trade Area and supporting that. We see the need to have that connection through the LabSet project, going north to, from Lamu all the way up, Ethiopia, Sudan, but also the Northern Corridor, and of course the A8 projects, Mombasa, Nairobi, Mau Summit, all the way to Malaba, is critical in our current focus right now, because we see that channel connecting us, of course, to the Copper Belt, all the way to Congo. We believe that road is critical, not just for the regional trade, but of course we need to unlock a lot of the domestic economy also through opening up of new regions, etc. On the rail side, of course, there's the expansion of the SGR that is envisioned. That does not sit with PPP, but of course there's a play for PPP from a rolling stock perspective. Once the rail is laid down, then we can see about private operators coming to operate some of the infrastructure. On the airport side, there's a project. Of course, we all know the situation with our airport. We could have slightly better infrastructure there. And so government is currently working on rehabilitation. That's the project that's coming, that's rehabilitating the current facilities. But from a PPP perspective, we'll be coming online with a PPP to do a new terminal and a new runway in the coming years. And really, it's to bring us to, best in class, basically, to compete with the others. And we're not all competing. I think as Kenya and as East Africa, we have to now look at it from a regional play. I think whatever Ethiopia is doing in Bishoftu will support our traffic, whether it's in cargo, whether it's in persons, but it will operate for us. Our play is looking at it beyond minerals. I have to put a play for that. Tourism is a big sector for us. So without efficient transport networks, we really can't unlock that.
Thanks for that. Philip, you've been, as you've said, involved in developing the Nairobi-Mombasa highway project. And based on your experience, what do you see as the challenges you faced in developing projects in Kenya? And what do you think you would like to see to be able to unlock some of these issues from a private sector perspective?
Sure. And I mean, I'm going to start the answer by saying that no matter where you're developing a project, anywhere in the world, it takes a lot of effort and a lot of work. It takes coordination. It takes engineers who can assess the opportunity. It takes government decision makers. And all of that is a very complicated process. The process of developing projects is not an easy one. Same thing in Kenya. It's not easy. It takes persistence. Sometimes I joke, I'm not sure if it's persistence or insanity, expecting another result.
Grit.
Grit. I'm going to say persistence, okay, because I wake up every morning saying I'm going to keep going. And what has happened over the last 10 years? There are significant improvements in certain areas. First of all, there was PPP legislation a few years ago, and that created a framework for doing PPPs that didn't exist prior to that time. Our first investment in Kenya was a power project under a long-term power purchase agreement, which had support from National Treasury. Today, with the PPP legislation in process, in a framework, you can look at a project, and I'll use our road as the example I'll get to, but I'll also say if you look at the evolution of what foreign investors are willing to do in the power sector, 10 years ago, they wouldn't be involved in a power project without a government guarantee or government support at the very least. Today, with the new legislation, a new framework, and the evolution of the expectation of foreign investors, I would say you can look specifically at a project itself. And we have today the staff. The PPP office is staffed. It has experts who understand what it takes to put these projects together. That's a very important ingredient. But beyond that, the project itself, if it makes sense, if it can stand on its own economically, and not all projects can. Some projects are done for other reasons. They're not inherently economic on their own. But in our case, we assessed the Nairobi-Mombasa Expressway project and said this project, because of the way it works, taking containers out of the port of Mombasa, it can stand on its own. That was a decision we made a long time ago. And we've proposed that in our proposal going back several years to Kenha and the PPP unit. But despite that analysis, one of the challenges I ran into, and we still do from time to time, is this outdated expectation that it's Kenya, so we have to have a government guarantee. It's Africa, we have to have a government guarantee. If we had these same projects in Europe or in North America, the investors would not be expecting a government guarantee. So maybe this is a personal passion of mine. I want foreign investors to look at the project, not just look at the fact that it's sitting in Africa and therefore we need a government guarantee. I'll leave it at that.
Thank you for that. Christine, I guess just going back to what Phil says, when you look at the possibilities and the issues that foreign investors face, this issue of, I guess we now call it government support measures, because there are certainly, there haven't been any government guarantees ever since. They've always been government support measures, including for the project that the Lake Turkana wind power project, which was always something that actually Kenya could do and stand alone from most of its neighbors, where it said, we will provide government support, but it will not be a commercial guarantee. And that's been a clear policy. But I think in terms of the challenges around different procurement methodologies, different policies of when you get government support measures or not, different procedures, what do you think can be done? And I guess because you sit on the government side, but you see the issues in terms of speed and execution. What do you think from a government perspective can be done from a policy regulation perspective to harmonize some of these issues and frankly build up speed on the execution side?
Thank you for that. I think in terms of what we hear from investors, of course, as you said, many of them come in expecting government support measures, not just political risk guarantees, but hoping to get some credit risk guarantees, which we do not provide. I think if you're an investor coming in, you're expecting to take up some risk, and for that you expect to be rewarded at a certain level. So in terms of the risks that you cannot take care of, government is very willing to step in and guarantee on matters, change in law, matters, any other political risks that may arise. So their government is engaged and provides letters of support. Of course, just for context, in this period, of course, that creates contingent liabilities for government, which government still has to manage. So that's why we still have to look on a project-by-project basis. There's aspects that we must negotiate. There are letters of support that ask for everything under the sun, including terrorism protection, which we really don't feel some of those things should sit in our letters of support. So I think what government could be doing maybe a bit more of that clarity. But I have to say we're in a journey. We are testing out the law currently. Every day new challenges come up, and we have to take a position on the basis of what is currently going on. So as government, at the PPP Directorate, we've worked very hard to work on template agreements, which does speed up negotiations. The regulations, we have the PPP regulations that are in process going through, the policies, guidelines that allow any investor to be able to simply understand the PPP process. But we also do a lot of capacity building. Anyone coming in, but also at the ministry levels, at government agencies, so that when they have a private sector counterparty, then they know how to engage with them. It is a journey, but I think every day we're doing a little more on it, and we are very open to engage and to problem solve along areas that we have not engaged in.
Thank you. Abhishek, I guess clearly the amount of investment required, not just in Kenya, but across the region, with these new disruptions and opportunities are massive. And clearly, government money, government funding alone is not going to solve it. And one could argue private sector funding alone may not just solve this problem. And so I guess the question is, for governments, and we're starting to see governments trying to develop strategies around what is that ideal mix? What is the criteria for where we just build it ourselves, stick it into our budget, pay for it, or through an EPCF structure like the SGR was, or then go to the private sector through PPPs or procurement or other structures. What is that mix? What should it look like? What should the criteria look like? So that, because sometimes we find the challenge is actually right at the top, where the government is asking, should we be doing this ourselves? Because it's a strategic project or it's a national security issue, which is what prevented, for example, privatization of ports and airports, because that was the view. What should be that criteria?
I mean, just in terms of numbers, if you look at for sub-Saharan Africa, bulk of the finance which was coming for projects, I think it's around 87 to 88% was coming from governments, treasuries. And you see that in Kenya as well, that literally all the major transportation assets are owned by government. Very different from many other countries. But it is a journey where if we don't have a new method of financing infrastructure, we are going to go through a decade of underinvestment. A lot of the sub-Saharan economies are debt stressed right now. And so the investment capacity that the government has is quite limited. Now, Africa is not the only continent which has faced this challenge. The same challenge has been faced in Asia, where a lot of the production, when it started to move from Europe and the US to Asia, the manufacturers understood that without having the critical infrastructure, those products will not be competitive or the timelines would be too long. And so a whole system of PPPs emerged. And today, if you look at the landscape and the acceptance of PPPs and the payments on PPPs, you find that it is a widely understood thing. So for example, I am from India, and when I go back to India, I have a card on my car windshield. Every road that I pass through, there is a toll that is collected automatically. It is well understood, and the amount of road infrastructure that it has added is absolutely phenomenal. All our big cities are now connected by 6, 8-lane expressways rather than... Now today, we have a situation where we have obvious costs of not investing in the infrastructure. So at the borders, for example, today at Malaba and Busia, we find long queues forming again, 16-hour queues forming again. We have done some pretty simple back-of-the-envelope collection, exercise on what is the cost to the Ugandan economy of those queues that are forming up. And it comes to over $300 million a year. Just the cost that the Ugandan consumer is paying for the congestion that is at the borders. Not even the whole road. Now, what is the cost of improving that infrastructure? Maybe $20, $25 million, because today we also have to have this, and we were discussing this at lunch today, that infrastructure today is not just the hard infrastructure. Just like in the mobile phone revolution, where we were able to skip the landlines and move directly to the mobile phones and the mobile payments, and today we are much ahead in that. Similarly, today with a lot of artificial intelligence that is coming in, a lot of the new technology that is there. So for example, at our borders today, the scanning can be sped up dramatically by using AI, and already it is being implemented by implementing image sharing between the two countries. So there are a lot of softer measures that can complement and reduce the infrastructure spend. But there is significant infrastructure spend required. And if we look at the loss that our economies suffer as compared to the cost of actually investing in the infrastructure. So I'll give you an example just at the border. With the traffic that there is, if we were to invest $25 million at Busia to improve the infrastructure, the cost per truck might work out to be $10 per crossing. Who doesn't want to pay that $10 and get rid of the challenge that you have in the crossing? Every transporter wants to do it. Every user would benefit from it. Every importer would benefit from it. But there is a bit of education and policies that also need to come in to create the models. As Phil was highlighting for power, we have now an accepted model. We don't have those for transport yet. There are a few which are being tried. There have been a few lack of success at the beginning of this journey on transport PPPs, but that does not mean that that is not the right direction. That is the direction we need to move in, bring in more private capital. And I've seen it in many other Asian countries where I've worked in. This is the way it will be. So 10 years down the line, you will be seeing a raft of PPPs coming in for infrastructure. It's just that we are in the journey and we're right at the beginning. Sometimes we can be a bit, uncertain about if we are taking the right way. And so I feel that very soon you will see that private sector would be the main investors in infrastructure in our countries.
Christine, I guess just to understand from a government perspective, this issue of mix and the criteria for the mix between what should still sit with government and what should be ideally moved out to the private sector. Is it the government's view that actually, in terms of what Abhishek is saying about the Asian experience, that ultimately everything should by and large be moved out, or is there still policy that says this is still best placed with government funding and only this will go out through to the private sector? what's government policy on this issue of the mix and what their role is and what the private sector's role is?
There's a clear policy around that there, and also just a commercial imperative. There are projects that government must do because it's a public good, and that they might not be commercially viable or bankable. So most of those would end up on budget, while those that have a path to commercial viability and bankability would then shift to us. Just backtracking a little, at the end of the day, PPPs do not come in, are not strictly a tool that is to be engaged only when there are fiscal pressures. Yeah, many countries have done them. Many countries with large budgets, etc., have done them as strategic tools. It's to look at what it is that is done better by private sector, or what it is that could be taken up by private sector, because at the same time it's government's role to stimulate private sector. So it has a multiplier effect, it has a job creation effect. In Kenya, therefore, when a project is either proposed or a particular sector has a project that they're considering, it goes through a very rigorous process of evaluation. Then the relevant ministry submits what's called a concept note that details the project, the scope of the project from a technical perspective, the economics of the project, the impact, both quantifiable and non-quantifiable, and why it's a good thing, and how it's aligned with the development policy of government. And that concept note is then submitted to the National Treasury, where now an assessment is done as to whether there is a path towards a PPP, or this should be on budget, and whether it is where it sits in the priority, because there might be other projects that are higher priority within the same sector. And so that assessment happens across several departments within National Treasury. So there's a funding process, and then there are projects that then come to the PPP, which then does its own assessment, a slightly deeper dive. And on that basis does confirm to the necessary agency that this is something that we believe has that viability and will go on our PPP pipeline, official PPP pipeline, after which then we look to embark on feasibilities. So similarly, now I've talked about a competitive process, but similarly, if it is a privately initiated proposal, then a private party would have approached the same contracting authority, and they would have to make an initial assessment. They have the projects that are already part of their plan, based on their strategic plan or master plan. But if there's a project that is proposed that is aligned, that somebody has seen has a path, then they would consider it, and if they think it has merit, would then submit it to the PPP Directorate to pursue. But at the same time, there's a role, of course, if it's a privately initiated proposal, to ensure that, aside from aligning, that it does fit into the realities of that particular sector and the circumstances. So, for example, maybe a little while back, there would have been a little more support on capital contribution into a project. That might not be the reality now. So it has to, again, stand on its own merit and be something that is palatable to the particular contracting authority.
To end the session, I just want to focus on pools of capital. I think in the 20 years I've been doing infrastructure projects and finance, when I dig down to where the money came from ultimately, whether it's debt or equity, I would say upwards of 80% is through a G2G arrangement and DFIs. So on the government EPC, EPCFs, largely G2Gs. And on the private side, it's the development financial institutions that are directly providing debt and directly or indirectly providing equity, because even the private equity firms and all ultimately are getting money from the same group of development financial institutions. The few changes I've seen is, for example, South African commercial banks. Sadly, not much from the Kenyan commercial bank side or the pensions or other players globally. And when you think about US private credit markets and the numbers being thrown around, or in Asia. Phil, you mentioned you're having to talk to investors for the project you're developing, and they have expectations, rightly or wrongly, about guarantees, etc. What do you think we need to do for Kenya and sub-Saharan Africa to diversify those pools of capital, which, like I said, from my experience, 80% of that is a combination of G2Gs or development financial institutions, which have their own peculiar needs, and we haven't gone into commercial banks, private credit, private equity, etc. Where do you see that coming from?
I mean, the answer to that is you would think it'd be straightforward, and in a certain way it is, all right? There's more liquidity, there's more money globally than there are good places to put the money. High level, very high level. The issue is getting a project to a point where it's de-risked, because if you can get a project to a point where it's de-risked, then there's plenty of capital available. And I'm talking about private capital now, not G to Gs. My whole career has been private capital. And there's a role for private capital and there's a role for government capital. And in particular, in the road sector, governments should be involved when a project cannot sustain itself, but it has a strategic value to the country. However, where there are situations like the Nairobi to Mombasa Road, the A8, it's coming out of the busiest port in East Africa, going to the busiest capital in East Africa and then beyond to Uganda and even to DRC. That road has the ability to sustain itself economically by collecting user tolls. And when we have the agreements in place, when investors know that we've submitted something that's acceptable to Kenha and it's acceptable to the PPP unit, there's more money than we need out there. And it's not only from the DFIs. I think your question is where else might the money come from? Certainly is coming from the DFIs, and one of the things that we do, and I'm proud we're here with AmCham today in this room with representatives of the U.S. government. U.S. government signals of support that we've heard this week are extremely strong in support of this project. And for those of you who may have seen this, our project is more than $3 billion US. Our application to the U.S. government is for $1.1 billion. Very strong signals this week that the government, U.S. government, is behind it. That's just a reference point. But there are other pools of capital that are available to projects like this. There's certainly infrastructure funds is one. DFIs, of course, but beyond the DFIs, there's sovereign wealth funds. There are strategic investors, some of the French and British companies that own infrastructure assets globally. Some of those are open to being investors here, some out of South Africa as well, even out of North America. Less so out of North America than out of Europe. And then there are pools of capital out of the Middle East and out of Korea, which have come to us with expressions of interest to be involved in this project because they see this as a project that inherently takes care of itself, and it's an opportunity working in a consortia, in this case led by Americans, to come together, bringing pools of money from the Middle East, might be sovereign wealth funds or family offices. There are some very large family offices out of the Middle East, and similar comment with respect to South Korea. So my answer to your question is, where else are there pools of capital other than the DFIs? Family offices, strategic investors, infrastructure funds, just to name a few. And again, in my opinion, there's more money than is needed, but you have to get the project to the right point. And I didn't even mention the Nairobi Stock Exchange. Would love to list this, but in my opinion, the right time to list this on the Nairobi Stock Exchange is a couple of years after it's been operating, not while it's in a development phase. So there are pools of capital, more pools of capital than we need. The issue is which ones can come on a timely basis and which ones will come at what stage in the development process.
I guess, Abhishek, the same thing for you, but with a slight twist, which is I think in Asia, you've seen a shift where large local pools of capital, whether it's the local commercial banks, the local pension funds, or the local capital markets, whilst have not fully replaced international money, they are playing an increasingly large role in many places in Asia. What do we need to do here to do that? Because the difficult conversation is when you're talking to an international commercial bank saying, but if the Kenyan commercial bank is not willing to do this, how are we doing this? And unfortunately, they need those guarantees, and it becomes a painful conversation. What do we need to unlock local, regional, continental capital for infrastructure projects? We could do it for real estate or whatever, but infrastructure seems to be a little harder for whatever reason.
Yeah, I think, first of all, if we are to have a large pipeline of PPPs in Africa, we have to have funding from the local institutions, because it's only the local commercial banks and the local developers who understand the risks and are able to execute projects within that. For example, for an international company, if you say that only 80% of the right-of-way has been acquired for a road project, you will not want to start that project because you will say, you know, what happens with the 20%? But if that same project was done by a Kenyan company who understands that if we have acquired 80%, we can start, and by the time we finish the project, the rest 20% would be acquired, or maybe 5% would never be acquired, and there would be a very narrow road for the 5% of the journey, but I can do 95% of the road and I can still charge the toll, that will work. Now, so having local construction companies and local financial institutions as a part of the financing mix is critical if we are to expand the number of PPPs that we see. Now, how do we bring them in? The most common way in which it has been done, so there are two parts to an infra project. There is the construction phase of it, and then there is the post-construction phase of it. During the construction phase, the infrastructure projects are highly risky because you have a lot of risk of delays, and so the project cost going up. Once the project is done, a road is done, or a border post is done, or a lake port is done, then you have a predictable stream of traffic and a predictable revenue source, very much like a bond. What a lot of the Asian countries have been doing is guaranteeing the debt of the projects through treasuries, even in the case of a developer default. So if there is a government default, yes, you do guarantee the debt as well as the equity. But even in the case of a developer default, they have been guaranteeing the debt of the banks, thereby giving the banks the confidence to participate. Second is, after the construction period is over, you have to open up the securitization market. There are a lot of pension funds. So during the construction phase, if you rate the project by any rating agency, you would get B- or C or something, which is not investable by a pension fund. But once the construction period is over, then all those projects are investable. They can get a very high rating as long as you have a good history of traffic along that infrastructure that you're using. Now, in those phases, if we have a strong securitization market developing in the region, then it is quite easy to do takeout financing for the banks. So you replace the capital, and you also reduce the cost of the project dramatically. The debt cost of the project can come down dramatically because what the pension funds require as their return is very different from what commercial banks are looking at return. And also from an asset liability mismatch perspective, commercial banks have short-term money, so they are not suitable for long-term lending. But the pension funds are. So it's how we structure it is the solution. I mean, What I know is that there is a lot of knowledge on this. I'm pretty sure the PPP unit is already working on some of this, but it's just that formulating them and having a few successful pilot projects on this model is what is essential to really open up the market. The market is ripe for such things.
Christine, on your side, I guess the same issue. What do we need from the government side to be able to bring these pools of capital that we're frankly not yet seeing in substantial numbers, and especially local capital, local commercial banks, pension funds, and our capital markets, and just bring that diversification and hopefully a different risk perception of these infrastructure projects?
I think some is already going on. One really has to do about regulation around how much pension funds can invest, right? So, and I think that's something that RBA is relooking at. We have the 10% cap for alternatives, and this is something that really needs to go a little higher to be able to allow the kind of quantums that we require for large infrastructure projects. That's one. Again, just generally the deepening of the markets, right? The financial sector in Kenya compared to, say, India. What is mentioned in terms of what is required, those things are actually in place. In terms of even what, developer default and guaranteeing of that pool. Lenders will not move on a project without that being in the agreement. But we have the limits of, single obligor limits for our banks. The size of our banks limits how much they can participate to some extent. So as we see consolidation in the financial services sector, as we're seeing what's going on with Netbank and NCBA, and that continues, and our banks become larger, then they're able to do slightly larger tickets, and that will really help us. But on the pension fund side, again, I mentioned RBA, but there's also a culture shift. As the pension sector grows, as trustees understand these more esoteric products, as we have more capital markets, listed securities that are related to infrastructure, that will over time, because I think at this stage where we are, most pension funds will be looking for listed securities so that they don't have direct exposure to the project. But there are a couple that are willing to participate. And interestingly, within our market, private pension funds, foreign pension funds are active, right? We have BlackRock is in Turkana, isn't it? And they cover quite a few funds out of Canada and the US and Asia even, right? So we need to have more fund managers such as that, asset managers that are probably participating in our capital markets right now, buying all those bonds, including infrastructure bonds, but now having them actually start coming and participating directly in infrastructure projects. Now, that's on their side. On our side, we need to have better prepared projects or well-prepared projects and also be telling our story better. I think as government, we could do a better job of communication that provides that transparency and certainty about certain projects and the pipeline. And that would probably make a few more financial institutions a little comfortable. But I have to say I have been impressed by those that come to see us, both domestic, local banks, foreign banks, other pension funds. Everyone is very keen. As Phil mentioned, there isn't a shortage of money. It's really about finding the right project, structuring the right project, telling the right story, and also executing, lowering the execution risk as time passes. Thanks.
Thank you for that. I will now hand over to the audience if you're up for questions on a Friday afternoon. Thank you. I see a hand up at the back over there.
Okay, because it is on critical supply chains, to the director, because critical minerals require local value addition, that is creation of industries. And maybe we have speculators here, So what is the current energy deficit in megawatts?
Clearly, we have a deficit of peak demand, and you can see we have imports from Uganda and Ethiopia that fill that demand. Of course, the deficit, then you have to think about the fact, if you look at the pent-up demand, right? Especially, say, from manufacturing sector. There's a lot of people that have gone solar that could have been on-grid and have chosen to do their own dedicated power. So I can't give you a number. I would say to go talk to the Ministry of Energy on that to get a little more detail on that. However, as a country, we are looking to invest a lot more. I think we all know our bills are pretty high, so we would look for that to come down over time. There are agreements we can't renegotiate, so our rates will be up for a while. But as we should be exploring baseload power, a lot more geothermal. We've only exploited 10% of our geothermal potential. It is a capital-intensive source of energy, but it's also stable, much cheaper, and really very much available in our country. Of course, aside from that, the transmission grid. So we can talk about power, but then if we're losing a lot, there are losses on the lines because they're old, or too long. That doesn't help us. So we must stabilize our grid. We must must expand our grid and make sure it comes online in time for any new plants coming on. Thanks.
Isaac.
Yeah, thanks, Amin. I think, Abhishek, you answered my question partially from the first question. But listening to all of you speak, a lot of the projects that we need to improve that supply chain are cross-border in nature. And I think as East Africa, we've struggled historically to do PPPs cross-border efficiently. What more can we do to get these projects done? Because there's no point doing a great road to Malaba, Busia, and then you struggle on the other side, when naturally these should just be one project. And the same thing when you talk about the lake or even coastal transport or even air transport. I mean, we all talk about SATAM and the issues there. So how do we address all of these issues? And I mean, you're also free to answer this one as well. Thanks.
I don't think that challenge is only in East Africa. I mean, if you talk to the Africa Development Bank, they say across the continent, regional projects are a challenge. I think we do need to figure out how to have better coordination and that capacity. I mean, there are agencies that are in charge of that. Let's say, like we have the LAPSET corridor. But at the end of the day, the technical skills are sitting within certain other agencies. And I don't know that coordination is happening well. So I think it needs top-level leadership. And this is my own thoughts. I'm not speaking for the directorate. I think where the agencies that have the mandate must have a high-level sponsorship directly with the parties on the other side, because to unlock an infrastructure that connects the two sides, for example, the SGR, and making sure that the investments are being made at the same time and that is not affected by political cycles or anything like that. Because at the end of the day, it's one piece of infrastructure after another, and it has to be well developed. That's just my high-level thoughts. I believe probably as projects come, like our discussion around minerals, and when you look at what's going on with the Lobito corridor and the focus on that, I think when there's a clear path to what sector it's serving, maybe some of those are easier to unlock when you can actually see a project that is doable, that it's executable. Those should be our test cases. Thanks.
You add to that, anybody?
So what we've seen is it also depends on the direction of the project. So if there are two countries with their own ports, it's much more difficult to have this coordination. But between Kenya, Uganda, Rwanda, there is much more stronger alignment. Uganda is extremely receptive to all projects, and both of us were in one of the CSS here who was talking about the level of pressure that Kenyan government feels from Uganda when projects are not moving. So there is a strong linkage on such projects. So there is a willingness to work on it. the only one thing we have to realize is Kenya is a lower middle income country, while the other countries are LDC. So the investment capacities are quite different. So when you see struggles with financing projects, also because we are at different levels on our economic cycle. But yeah, there is a strong alignment actually within some of the other ESC countries.
Yeah, I think, Isaac, to just add to that, I'm seeing a lot more integration within the region than before. When I think about doing deals 15 plus years ago, it was a handful. I mean, we did RVR, and whilst that was a great example of regional coordination, unfortunately, commercially, the deal didn't work out. But that was a great example of how regional infrastructure should be coordinated and packaged into one. But I think, unfortunately, because the deal didn't work out commercially, everybody has scars, and then they try and do their own thing. But that is a great example. When we did Teams, the undersea fiber optic cable, which then linked to Uganda, Rwanda, etc., another great example. But those examples, frankly, were few and far between. But today, when you think about what we've just discussed, the ability to import power from Ethiopia and Uganda, when you think about the South African power pool to do power projects in places like Zambia and all, when you think about the connectivity with DRC to Tanzania, etc., I see huge movement. And every time I speak to governments, and you can hear issues around competition, and my simple view is, and I learned this from our previous PS demo when we were doing Teams, when there was a concern that, well, if we do one undersea fiber optic cable, then that's all we will need. A region of 200-300 million people cannot have one port. You can have a highly successful Dar es Salaam, a highly successful Mombasa, and potentially Lamu and Bagamoyo all tossed into it. You can have a great airport in Addis and a great airport in Nairobi and everywhere else, because that's what brings it in. But I think we're starting to see governments move around this competitive thinking about, if Dar gets better, then there's a problem with Mombasa and vice versa, where they're understanding this is a much bigger regional play. So I personally do see better integration, but we do need cross-border deals like the old days, like RVR. That I'm not seeing enough of. Last question.
You had asked Phil about some of the challenges that one faces, and I ended up drawing up a long list, but I won't go through the list because there are quite a number of them. But I wanted to just address two of them, which just I think we have not really addressed, at least in this forum here. The role that China plays in this, because I mean that's been talked about quite a lot. And so one of the things that I'm finding is that a lot of projects that have been done here have been financed or structured with China in mind. And so, and I mean, I'm going to ask you this question first. I mean, when we're looking at the PPP, and then Christine, you're next, what role is the way China has been doing projects influencing the way we are looking at how the PPPs, the ones that are being reviewed, are being considered? Because I can't help but wonder that is playing a role in how we are looking at the financing, looking at the structure. And I'm also struck, I mean, Isaac mentioned something about the road to Malaba. Everyone keeps talking about that, but people forget that to get to Malaba, you have to go from Mombasa to Nairobi. So when you asked, Phil, when is the Mombasa-Nairobi Expressway happening, it must happen quite soon. Otherwise, it won't get to Malaba. So that's the one point that I just want to make. So the question is, what role is the way China approaches this? Because that road to Malaba, the PPP unit reviewed. Well, I'm going to make a point here. I was looking at the way things happen, the concept note, how projects get to the PPP directorate and everything else. For that one, you have 20 days to consider it by the PPP unit, I think that's what it is, or KENHA. And then the directorate has another 10 days, so that's 30 days. For that one, with the Chinese, it took 15 days, all of it combined, so they cut it in half. So I'm curious how quickly that can happen, because some of the challenges that I was going to raise was in relation to raising capital and giving confidence to the market so that they can invest and they can unlock some of that money. And the reason I bring that up is because we're talking about PPP, public-private partnership. And when we've been going through this process that you described, it almost feels like the private sector is having to jump through so many hoops. So I'm wondering, when is that partnership? When does it kick in? So that's a question to you, because I haven't felt it yet. That's the part. And then, so China, and then when does a partnership kick in? Thanks.
On the PPP side or on the China side?
Both. I'll also deal with the China side.
Okay, I'll let you deal with the China side. I'll deal with the PPP side. The PPP side, at the end of the day, it all depends on, there's all PPP start, as I said, from the contracting authority. And at the end of the day, I'm sure being at Everstrong, you've been talking to the same agency, right? So it's the nature of the conversations. We focus on the piece, on the economics of the project and the project readiness and responsiveness. And a lot of that from a technical perspective is dependent on the agency. They're the experts from a technical standpoint. We come in and translate that into what it means from a risk allocation standpoint and contractual standpoint, and ensuring that that project is affordable to government, if it is a government pay or whatever. But all those aspects, the technical aspects, are key to how fast it moves. Specific to your project, it required a lot of land acquisition at a time when government is saying it's broke, right? So the feasibility, and that's the word, the feasibility of a project, how it's been designed and how it's aligned to what is possible for the government to engage is key. And I think that was well communicated. So this is why, and I think Phil mentioned that, maybe now you're listening a bit more. There's a need to look at the constraints of government, the fiscal condition, and so that's the thing. So if I can't speak, I can't compare, because KENHA is the one that determines who they go with, but I would assume then the listening happens. So for us, that will determine how quickly it goes. And I think your conversations with KENHA have been as long as probably even some of those parties had with KENHA. The issue is, when is it triggered and when do documents come to our desk? Now, the timings that you said, based on when you've come to our desk and how well evaluated it happens. I have projects that take a long time. KENHA is a little further ahead as compared to some other contracting authorities in terms of their engagement with the PPP process. We have others that are a little further behind, and that timeline takes a little longer because they haven't, it's a learning curve for contracting authorities who are used to doing EPC contracts to move to a PPP and to be commercially aware, etc. So every project has its timeline. There are things we've had to put on pause because it needs to be further developed, and that's just the nature of things.
So look, we've dealt with not many, but a few Chinese corporates doing transactions, especially on the infrastructure side. My personal experience is it's very different when the deal is structured as a G2G versus when it's done as a PPP. My experience on the PPP side is actually it's not dramatically different in terms of what the requirements are. I think the one difference I do see on infrastructure projects done by the Chinese on a PPP basis is they take a longer term view. So their assessment of risk can be slightly different because they'll take a longer term view from a developer from the West. But beyond that, on key issues around land acquisition, political risk cover, certainty of payment, frankly, there's no difference. But if you take a 40-year view versus a 10-year view like a private equity out of New York or London, your assessment of risk is very different. And they will take a 40, 50-year view on a project, which then does impact how they assess risk. But on 90% of that stuff, it is the same risk allocation assessment. It doesn't matter whether they're from China, India, Indonesia, or Europe. People want to know, is the land okay? What is my certainty of payment? What's my political risk cover? What's my termination risk? It's nobody is taking shortcuts in my experience. And like I said, we're dealing with an entire host of people, including from the Middle East, where again, there is an assumption that the risk allocation profile is different for the Middle East and for China and for Asia. In my view, it isn't. But there is a longer term perspective. But this is, I'm talking about pure PPPs. If it's a G2G, that's a whole different ballgame. Thank you very much. Thank you to the fabulous panelists and for you being here on a Friday evening. Very much appreciated. Thank you, AmCham.